Good afternoon, everybody, and welcome to this 𝗟𝘂𝗍𝗂 panel discussion on transition finance. Before we deep dive into this exciting topic, just a reminder for the audience, there is a Q&A box on the right side. So if you want to ask questions to our panelists, just feel free to write them down there and we will address them at the end of the session. Now let's jump into the core of our discussions. If you've read the press recently, you may have seen announcements by the largest fossil fuel companies like Total, Shell, BP, and the likes, who make ambitious announcements to shift a part of their revenues to renewable energy and also make pledges to cut their emissions. On the other side, we'll also see a number of big institutional investors that are taking actions to divest from fossil fuel investments. This morning, in an article from the Financial Times, there was also a quote from Ms. Lagarde from the European Central Bank, who was calling on central bankers to ask themselves if they were taking excessive risks by trusting markets to correctly price environmental risks. So these questions around high carbon emitters are really questions that are raising passion, and eventually it all boils down to one question. Should companies that are today considered as operating in stranded assets be viewed as part of the problem? Or can they be also crucial in solving that problem? So to help us see through this concept of transition finance, I'm delighted to introduce you to our three renowned panelists. Paul O'Connor. Paul is a sustainable finance specialist with over 20 years of experience. Paul currently leads JP Morgan's ESG debt capital markets offering in the EMEA region. Laurent Morel is a partner at 𝗟𝘃𝗲𝗂𝗏, a consulting firm specialized in low carbon strategy and data for corporates and financial institutions. And Ulrik Fugmann, who has over 20 years of active investment management experience. And today, Ulrik co-runs the environmental strategies group at BNP Paribas Asset Management and is part of the firm's global steering committee for ESG and sustainability. So let me start with a question to Paul on what is exactly transition finance and how does that differentiate from the concept of sustainable finance that we've heard for the last decade?
Sure, yeah. Thank you and good afternoon. So what is it? Effectively, the way I see transition finance is a concept which allows those industry sectors and companies within those sectors that have historically been seen as part of the ESG problem, if you will, or who are confronted by ESG challenges. It's a way for them to access the investor interest in putting money to work behind business models that are part of the solution. So if you're in a very carbon intensive sector or a high impact sector from an ESG perspective, the concept of transition is really about you developing a strategy whereby you commit to addressing your ESG challenges and moving along a pathway toward being a less high impacting industry sector or less high impacting company. So it's about a journey, and it starts with a recognition that historically you have come from a place which is associated with higher ESG impacts, but you want to be progressive. You want to be part of the solution. You have a strategy to address the issues and move in the right direction, and you want to engage investors to support you by continuing to finance the business and effectively providing the capital that you need to make this transition. So that's in effect how I see the concept of transition. So starting from a place and moving in a certain direction based on increased societal sensitization to ESG challenges. How does it differ from sustainable or climate? I mean, there can be a fair degree of overlap, and we see the terms being used fairly interchangeably in the market. I guess really for me, it's about a label or a term which is designed to kind of head off accusations of greenwashing, because implicit in the use of the term transition is an acknowledgement that your business does have some ESG challenges associated with it. You're not claiming to be green, you're not claiming to be sustainable. What you are saying is, we acknowledge and we recognize the issues and we're committed to doing something about them. So that's, to me, the main difference between other labels like sustainable or climate. I mean, obviously there can be a fair overlap, particularly in the case of climate, but that's really how I see the term. It's about an acknowledgement and reflecting the company's wish to be progressive and move in the right direction.
Thank you, Paul. From what you said, I understand that then transition finance is a journey that also needs to be inclusive. And that concept of transition finance is discussed as part of the ICMA, so the International Capital Market Association working group on transition finance. And surprisingly enough, that working group is not about a specific instrument. So it's not about bonds, it's about a concept of transition finance. So I was wondering, what are the possible instruments that could accompany this journey towards transition finance? Could you tell us a little bit more?
Sure. Yeah, absolutely. So the way I think of it is a bit like an orchestra. It's less about the instruments in the orchestra. It's more about the music that's being played. And so if you think of the company's strategy as the music, it doesn't really matter which financing instrument you use to communicate that strategy. You really need to just figure out which one works best for you. Now, for some companies who are what I would say, capex light or dematerialized, who don't spend, high volumes every year on capital expenditures, the sustainability linked bond structure can work quite well for them, where it's a general corporate purposes bond, but it embeds a performance target and an incentive mechanism to incentivize the company to deliver against its sustainability objectives. So that is one instrument which is available to people who are committed to this transition journey. Of course, other companies are quite capital intensive, and they do need to spend a lot of money to get them where they want to be. And so a use of proceeds bond could work for them, and that would be similar to the way that a green bond instrument would work, where you provide the investor with some visibility of where the money is going and explain, how that is going to help deliver the strategy. But really, the best way to think about all these things is, is the strategy the right one? Is the strategy meeting investor expectations? Does the strategy reflect, government policy direction and expectations for the sector as a whole? If the answer to that is yes, then it's a question for me of using the financing instrument that best works for the company. We see quite a lot of focus on these different instruments, sustainability linked versus use of proceeds. We have it in the loan space, now we have it in other types of financial instruments. So it's easy to kind of get bogged down and confused, but really I think most investors who understand these things are looking through to the company's strategy, and then we'll be looking for an instrument that works for both sides. So works for the issuer and works for the investor. But ultimately, it's about communicating that core strategy around the transition. So that's the way I think of it.
So we shouldn't exclude the use of proceeds type
Absolutely. I don't see, I have seen some comments setting these things up as a competition between each other, but I don't see it that way. It all comes back to the strategy. And for some types of issuers, they will find the use of proceeds type model works for them. For other types of issuers, they will find that the sustainability linked type structure works better. And there's in fact there's no reason why you couldn't do two together, and we have seen them used in concert by some issuers. So it's a mix and match, and whatever works best. So I wouldn't set these up as a sort of a competition. I think it's really ultimately up to the issuer and the investors to decide what instrument is best given a particular situation. So I see these as options. They're on the menu. But really, I think the focus should be maintained on the corporate strategy, and that's what should be tested, rather than focusing too much on the type of instrument that's being offered.
Thanks. Can you, however, explain for the audience maybe what are the sustainability linked bonds? What are the key features of them? Because they are pretty new in the market and pretty innovative. So if you can explain just in a few lines.
Sure. So in summary, it is a general corporate purposes instrument. So there is no visibility or commitments being made around how the proceeds of the bond are going to be used. Rather, the instrument is designed to incentivize the issuer to deliver a particular outcome. And the way the bond is set up is to include a performance target like decarbonization, or percentage renewable energy, or emissions of carbon per unit of whatever product the company is producing. So you commit to a target with some milestones, and then you test yourself as to whether or not you've met those targets. If you fail to meet them, then there's a financial penalty on the issuer. And there's a number of different ways of doing that. The one we've seen most commonly is a coupon step up, where the coupon payable to investors steps up if you miss the target. There are some other options such as premium payment on redemption, but effectively they amount to the same thing. They give the issuer an incentive to deliver against the sustainability performance target. So that's how the sustainability linked bonds work.
Thank you, Paul. So you mentioned as part of these SLBs, it's the issuer who sets ambitious KPIs and relevant science-based targets. And that brings me to Laurent, actually, from 𝗂𝘃𝗲𝗄𝗏, who's dealing with such data, carbon data. So what kind of data is available on the market to assess whether an entity or a product is transitioning, or an activity, sorry, an entity or an activity is transitioning fast enough towards the deadline? What kind of data do we have on the market?
Can you hear me?
Yes.
Okay. Well, thankfully, more and more. I mean, there's more and more available data on the market, and it's very impressive how for example, the TCFD, the recent TCFD initiative. Can you hear me? Yeah, yeah. How the TCFD initiative has been fast to have corporates accept to disclose a number of data that were not available at all, say 5 or 6 years ago. I mean, it's been extremely fast, and it's a good thing because there's an urgency when it comes to the transition. But still, I mean, if you look on history, how long it has taken to corporates to master the traditional accountancy measures, and it's been extremely fast in a few years for big corporates, investors, and all the community to get accustomed to these new metrics. Okay, so what type of data you need? Of course, scope 1 and 2, the direct energy consumptions of the company. But I'd like to stress that, of course, scope 3 is the one thing that you need absolutely to achieve. It's no longer a nice to have. I mean, scope 3 is I would call it an irreplaceable tool to assess the exposure of a company to the transition risk.
Yes, it's easy to get that scope 3 data.
Well, yes, it is. I mean, there's a lot of argument about this being quite difficult to work out. This is not the case. I mean, it's not that difficult. There is at least one example, and I could tell at least one example in each and every industry of a large corporate that communicates on their scope 3. So it's absolutely not difficult to do. And really, there's no option. I mean, you absolutely need to deliver that figure if you pretend to make something in this field. Okay, so there's no excuse, in fact, for not communicating on this figure. Anyway, at 𝗂𝘃𝗏𝗄𝗏, we provide a calculation of this scope 3 for each of the thousands of corporates we track on the bottom-up approach. So this calculation is based on the physical flows linked to the activity of the company, the feedstock, the energy involved in the transformation of products, and the emissions related to the use of the products themselves. So in any way, there are people like us who provide a calculation, either to cross-check what the companies disclose on, and to check the consistency of their disclosures with regards to the community of their sector. I mean, to bring some consistency to those disclosures. And if to some extent some still don't want to disclose, I mean, you've got people like us delivering a rather good assessment of these scope 3. So, I mean, wherever you are in this field, you may use this scope 3. It's absolutely the tool to measure the exposure to the risk and the impact as well. Okay, so that's really, and of course, this is the basis for any forward-looking analysis, because when you're looking at the strategy of a company, definitely you need to measure where the value chain is exposed. That's the upstream Scope 3 emissions. And to what type of market, through which products, the company is exposed to transition, and this is the downstream Scope 3 emissions. So this is something very much available, understandable. It just needs a bit of application to get into that, and it's extremely useful and powerful in predicting the transition.
Thank you, Laurent. I take your point on the importance of Scope 3 emissions, and I will be monitoring the market to see if that really happens at some point. But this carbon data is very specific in the sense, and you mentioned it, that it's science-based, it's quantifiable, but it's very different from the type of ESG data that we've seen in the past that asset managers are using. For example, the ESG ratings that asset managers are using. And Ulrik, here you're representing asset managers, so I'm going to ask that question to you. Are we using the appropriate indicators when we speak about transition? And is there a risk that asset managers that just buy this data from different data providers without understanding what's behind the data?
Yeah, well, first of all, thank you very much for having me. Yeah, I think you're absolutely right. I think the first thing that we've observed when looking at ESG data is that the correlation between ESG data from different data providers are pretty much zero, which means that one ESG data point from one provider can vary very much from the other, and that's got something to do with, we've got three very important letters that we've decided to put together into one score, but they illustrate something that's vastly different, sometimes interconnected, but in reality very different, and have really decided on the basis of some underlying KPIs. So if you take an E pillar, there is a battle amongst giants, I would say, in regards to how companies are acting and what they're doing. So it's kind of the trade-off between how and what. And what I mean by that is that you can have carbon polluting companies having fantastic sustainability reporting and measures in place, etc., which makes them look great on an E-score, but in fact they can be some of the worst polluters in the world. So it's really complex actually to build an ESG score, and you're right, I think that's not necessarily always considered, and that's why putting portfolios together blindly on scores can be very dangerous, because it might end up that the investor actually doesn't achieve the outcome that he really desires or wants to have. So I would say there is a real risk that that's the case. There's a lot of people that are also talking about the need for standardization within these ESG scores, and that can also be very, very difficult, because again, ESG is not one thing. It would be the same as saying I should be valuing companies using only one valuation model. That would also be wrong. Again, people are using ESG scores for a variety of different reasons, and it would be hard for me to say that one is more correct than the other, because it all really depends on what the objective function of the investor is. And I think that's where a lot of the focus needs to be, rather than sort of immediately throwing oneself over scoring a portfolio on E or S and G and drawing too strong conclusions. I think both allocators as well as asset managers need to sit down and just kind of say, what is it first we're trying to achieve? And it's incredible actually the amount of different replies you get within organizations, because different stakeholders trying to achieve different things. And so that's a really difficult question actually to answer. What's most important? Is E more important than S, and is S more important than G? And again, you can have a different discussion around that. So absolutely, I think there's to answer your question in short, I think there's a big problem around data, not just availability but also use of it, because it's extremely powerful, but if put in the wrong hands, so to speak, it can also end up with the wrong results, and indeed in something that the investor actually think is an ESG portfolio, but in fact is achieving something completely different.
Yeah, absolutely. And I concur on what you said, that all these ESG ratings, they are correct in a sense, but they are different because you need to understand what's behind. You need to understand the methodology behind. And that takes me to what Laurent said, actually, about the scope 3. I see many funds, right, reporting on the carbon data or carbon footprint of their portfolios, and then they look at scope 1 and scope 2 and not scope 3, for example.
Yep.
And I'm not sure how there's more investors that understand now what is scope 3, but I'm not sure all of them understand what it is. And so I wonder also if there is a risk of transition washing on that, if I can say.
Yep.
Because you'll just see that number, you don't understand that it's just scope 1 and 2, and that usually the largest share of the emissions are scope 3, and they're not included in there. And it's just a number, it's a good number, and so that's fine on their side. So what kind of safeguards, maybe that question goes to Laurent, what kind of safeguards we can implement to avoid this risk?
Yeah, well, I very much appreciate what Ulrik said. I think it's both a powerful but dangerous tool. I mean, those data, if you don't know how to use them. Of course, there is as much a risk of a fake approach as there are huge opportunities if it's carried out properly. You know, it's an extremely powerful tool to tell which companies are going to fare well in this transition. But if not properly used, it can definitely be a transition washing process or big mistakes. So I think when it comes to ESG, I would like to just to mention, and Ulrik said also that there can be some confusion there. I mean, each of those risks, E, S, and G, are not cannot be assessed together. One poor ranking in one sector cannot mitigate the rest. I mean, each of those risks can kill you. Okay, and specifically when it comes to the climate risk, the E. I mean, if you are not okay with this risk, I mean, you may be very well in S and G, but the company is going bust anyway. So I think you should definitely look at those risks on an individual way. So yes, I think the risk lies there in relying on simplistic approaches. Okay. Excluding this or that, taking part of the data, scope 1 and 2 only, etc. So it's tricky to understand, but the fundamentals of climate change are a bit tricky to understand. So I think, yeah, I mean, the only safeguard is, and again, I think Ulrik is very right there, you've got to get educated to the subject. I mean, young people are, in our generations, it takes a few weeks of courses to understand. Older people, like we are, the people in charge today, are sometimes believe they can master the subject with their just common sense, with what they know already, and that may be not enough. I mean, you need to get to understand those data. So I think this is where the first movers are going to take a huge advantage over the years, because they get educated to these data. They know how to use it. They use it properly, and in the end, those people are the winners of the asset management in the years to come. Because I am definitely convinced that climate risk is the one major risk and opportunity factor for long-term investment in the years to come.
So education is key then for the young, but also for the more senior.
Yeah, we should accept the fact that this is something we haven't learned at school. We learned a number of things, but it takes probably 20 hours altogether to understand the climate risk metrics, to understand the link between the GDP and energy, to understand what is at stake when we're gonna see the increase of the general sentiment in the population, in the politics towards new regulations, etc., etc. So it takes some time. It's not that complicated, but you should do it. And this is this would be my advice. You should take the time to get into that. It's the reward can be enormous.
Because education is the key safeguard, I understand, to transition finance. There's also a number of standards and papers that we see emerging on the market. There's a lot of work, and Paul, you're probably aware of that, from the ICMA, International Capital Market Association, also from the Climate Bond Initiative on this recently, specifically on transition finance. That's international standards giving their opinions, but I was wondering whether there's also some work from the regulation and what kind of regulation is playing a role into transition finance. Maybe to Paul that question.
Sure, yeah. I mean, I would say historically that regulation has been a fairly weak actor. The investor preference and response from companies is really what's been moving things ahead. Now that has changed recently. The EU has a very ambitious sustainable finance platform under development, which you have probably heard of, things like the EU taxonomy, various associated regulatory initiatives. So I think the push from government policy is definitely becoming much more noticeable, and we already see in our interactions with investors an effort to prepare for alignment with things like the taxonomy. Now it will take time, and there will be some there's that word again, transition involved, but you know, there has been a clear steer from the European Union institutions as to what the direction of travel should be, and you know, there will be an ongoing effort to align with that. I think there's a much clearer understanding now of the role that different technologies have to play. You know, some of the technology options are already, you know, scaled, you know, commercially viable, costs going down dramatically, already well in the game. There are a few more technologies that we need, you know, things like the hydrogen economy, carbon capture and storage. Some of these things still need some government support to be scaled up and to kind of create the economic incentives for people to invest in these, but they are definitely part of the solution. I think there's a recognition of that. You know, and I think government will be getting on with the business of trying to find ways to, you know, help scale these technologies. You know, the costs at the moment for some of these things are pretty prohibitive, but you know, there are ways to address this. You know, industry partnerships is another thing that we see happening, where groups from one industry get together with groups from another to take forward these industrial ecology type ideas, where here I'm sitting on a load of hydrogen, I don't have a market for it, you're in a different sector over there, you need to create heat in your industry, and so let's work together to get you some hydrogen, and you know, you can burn that instead of what you're burning at the moment. You know, that type of thing I think we're seeing more of, and we'll continue to see more of, but we need ways to unlock you know, these partnerships and get people working together, and government has a role to play in that. Things like carbon pricing are also going to drive things in the right direction. You know, you might have seen in the European Union ETS that the price of carbon, you know, has gone from around 4 or 5 euros a while back. It's up around 27, 28, 29 type area now. You know, that is a strong signal to people who are in carbon intensive industries that, you know, the economics of transition are changing. So carbon pricing is another important government supervised incentive for industries to, you know, hasten, you know, progress along this transition pathway. So the summary is government regulation policy is becoming more important. It's already quite important in the European Union. We see other jurisdictions following suit. There's been some eye-catching announcements from Asia in particular recently about kind of net zero commitments. So that is, you know, as I say, very eye-catching. Depends on what happens in the US, but obviously the pendulum over there could swing back depending on the results of the US elections. And, you know, we see things like climate change being actively debated on the US side now as well. So gathering tailwind is how I see government policy, but at the moment it's still investor asset owners who are really driving the bus at the moment.
Thank you, Paul, for that. I'm looking at the Q&A box and I don't see any questions in there. So just a reminder, unless you see it, but I don't see any questions in there. So just a reminder for the audience, if they want to ask also questions, feel free to write them in there. As long as there's no question, I can also continue myself in asking questions. And the question that I had is a very specific one. We've talked a lot, and when we talk about climate finance and transition finance specifically, we talk about environment and we talk about climate. Some of you mentioned that specific S in the ESG, but I was wondering whether transition should also be monitored by specific social indicators, social KPIs. And that's a question I'd like to ask to the three of you. Maybe to start with Laurent, because you're in the data field. What are the social indicators then?
Yeah, it's very true. We more and more when we look at the transition, not only for the financial industry, for the finance industry, not only for the finance industry, because our major business is with big corporates that we advise on their own transition. So very much what is key to transition is that not only the CEOs and their management team be aware of the metrics and the what is at stake, but also to make things happen, for the transition really to happen deeper into the organizations. You need a common understanding of what is going on. And again, it's about education. It's about having a large chunk of the population aware of what is at stake, and because it's quite technical, Paul was talking about hydrogen and carbon capture. I mean, those things are really technically savvy, tricky. And you need to have consumers, citizens, politicians, financial institutions, corporates, bankers, all move in the same direction at the same time. Otherwise, things don't happen. I mean, it needs a common understanding of a global transition. And again, I mean, it needs the people to be educated on the transition, to see where the dead ends are, because there are a few, where the real nice ways to be transformed will happen. Okay, so in that sense, yes. In that sense, when it comes to, for example, if you're talking about S, you're talking about inequality. I would say the major inequality is about the knowledge, and who is aware of what, and who is familiar with what. So it's about education again.
Oh, I'm really glad to hear that, and then we'll take you as part of the LGX Academy then, if you're so strong about education. I see that we have questions now on the Q&A, very interesting questions actually around SMEs. So I'd like to ask you those questions as well. I don't know if you see them, so I'm going to read them to you. Scope 3 emissions measurement is already hard to achieve for large corporates. And given this complexity, how can we encourage and support SMEs to disclose such information? And broadly speaking, how can we embark SMEs into the transition journey? Anyone wants to take that question?
Yeah. Oh. I'm happy to have a go at that one. So yes, I mean, I completely get it's in some ways much easier for larger corporates who have a lot of internal resource to do all these things, and some of them can do it, unilaterally. I mean, the way I see that SMEs can move themselves along is to work with industry associations, so that the industry association representing that sector could take the lead in establishing a working party, and that obviously helps share the costs around. And so industry associations, I think, can be important. We have seen some industry associations recently become quite proactive and progressive on ESG, representing their members and putting together working groups. So I think an effort to reduce the burden on individual companies, the sector associations can certainly help with that. Also, government may have a role to play in terms of funding, research programs and generating information, data sets, and guidance that all the SMEs in the sector can benefit from. So there are a couple of the ideas that I had on my side.
Right, Laurent, Ulrik, did you want to add something on that?
Yeah, of course, SMEs. I mean, it's very contrasted. I mean, some are really lagging behind, but also at the same time, we find a number of younger companies very aware with the metrics, the transition, the data, quite savvy on the matter, and they are taking shortcuts, you know, in this transition, and taking a hugely interesting positions when it comes to their products. For example, I have hundreds of examples like this. Newcomers on the market who just, well, by the way, take advantage of this new paradigm, I would say, of the transition to set up the right organization and be positioned on the right products from the start. So I think smaller companies are going to be key into transition. At some time, the larger corporates, even if they understand at the top level the issues, may be a bit longer to act because they have to move their entire organization, the entire value chain, to transform their relationship with their shareholders, etc. It can take time, whereas smaller companies can have extremely powerful products, and again take advantage of transition. I think, of course, when you talk about that, you can mention Tesla, and you see how this company is currently disrupting completely the automotive industry, because it has taken the right move from the start when it comes to a transition. Of course, the electric vehicle is the future, at the expense of all other type of engines. So this is one great example of. There are many, of course, and there will be more and more of companies that are small at the start, but take the right position. And the transition is full of the climate transition is full of opportunities. So and smaller companies can sometimes be in a better position to take advantage of that.
Maybe then also another reflection on that is that SMEs should not be penalized on the amount of disclosures that they publish on climate, but rather on their knowledge about the topic. And that echoes what you said about education. So how the governing bodies of these SMEs understand the topic rather than how much documents and reports they produce in terms of disclosures.
Yes, but again, understanding is like for me and you and all of us, it takes a few hours. So it's the same time for the CEO of any large corporate and for the owner of a smaller business. You know, this transition puts everybody on the same position with the same chances.
I see another question here in the Q&A, and it says, isn't there a trend to oversimplify the assessment of ESG risks? Don't we need more engineers and people who understand natural and social science working together with finance professionals? And that's something that we've seen now, that asset managers have or integrate specific science professionals. Ulrik, maybe that's something you've experienced at BNP Asset Management.
Yeah, so it's I think you know, that's a great question. But maybe just one comment first, just 2 seconds on the last question, which is sort of this idea of isn't it a bit unfair for SMEs to have all this disclosure, you know, and how do SMEs deal with it, you know, which I understand sort of was the question. I think that's true, and I think there's can be a risk of having bias where you ESG disclosure is being biased towards large companies versus smaller companies, and that's of course an effect that we certainly don't want. And therefore, in my own personal opinion, do we need to be a lot more focused on what companies are doing, you know, in terms of their products and actions, and less so on, you know, are they you know, issuing the right, you know, 60-page document, because a lot of the SMEs just simply can't afford it. They're young companies, they want to innovate, and all of a sudden they get a 440-page EU taxonomy report slammed on the desk and say, go to work, you know, we'd love you to fill this out. There's just no capacity and no time for that. So which then nicely actually comes into the other question, but again, I would quickly agree with Laurent that, you know, for example, we're running an all-cap portfolio, and what we're seeing is that it's on the SME side that the real disruption is happening. Everyone can buy Vestas and 𝗟𝘂𝗃𝗃 to get, you know, wind turbine and hydrogen exposure, but these companies are getting threatened by smaller companies that are have a lot of access to capital, even now, you know, amongst COVID, and are being disrupted. So that's super exciting, and I think we need those smaller players. They are the ones that's going to speed up the transition, not the bigger companies. So 100% agree. Now, in terms of oversimplification of ESG, it's a double-edged sword. I would say yes, we do a lot with academic institutions, whether it's Oxford or Imperial College or Cambridge, where we're speaking to academics around, you know, measurement of E and S and G and how to think about it. And the problem is that it's academics and it's academia, and we need to sort of translate it into the what I call the battleground, you know, where the rubber meets the road. I come in the morning, I turn on my screens, you know, and we need to start investing. And I need to use tools that are practical, that are easy, and that gets us to where we need to be. So on one hand, it's true that there is a possibility of oversimplifying it. Because at the end of the day, why did ESG start? It was to try and assess non-financial risk that we couldn't just put a number on. And what are we all trying to do? Put a number on it. You know, 80, score 80, score 20, score 30. So we've just done a big U-turn where we acknowledge that there's things we can't put numbers on that we're desperately trying to put numbers on, and it's becoming a big industry. And that's why I think we need to keep it a little bit. We need to make sure, you know, again, when people are talking about standardization and reporting and, you know, all of these things, it's really, really very dangerous, because I prefer there not to be standardization. I like the fact that it's up to it's between us and other asset managers to participate in this what should we call it, not race, but in this idea of having more and more impact. There's no question. This is where the industry is going, and this is also what investors want. And by creating a standardization can be the lowest denominator. All of a sudden, job's done. You know, happy days. It got served on a silver plate. We don't need to do anything. Hooray! You know, 𝗂𝘃𝗄𝗎 Matata. But that's not what that's not what we need to do. What we need to do is make sure that everyone is incentivized to keep developing their ESG frameworks, that they don't just rest on their laurels in terms of some EU standardization or others, and exactly as this question says, working together with other asset managers or academia to get a good tool. But what I have learned in my career is keep it simple. You know, by keeping it simple, you know, you get something that's practical, because ESG can be made unbelievably complex, and all of a sudden you've sort of landed in the ESG swamp where you're drowning and you just don't know, you lose direction. So I think it is, rather than oversimplifying ESG, I think what we need to do is oversimplify messaging and what we're trying to optimize for, and then ESG comes out by itself. You know, it's actually beautifully easy in that sense. We run an environmentally themed fund, so we have a much higher weight on E factors. What we try and do is solve for climate change and carbon. You know, and S and G is important. Why is it important? It's because we don't want to have investments where we can slip up on S and G that is a non-financial risk in some of our investments, and that's why we check for that and spend a lot of time on it. But E for us, is really what drives it, and hence we spent a lot of time on carbon, waste, and water, and on Laurent's extraordinary data set.
And Laurent couldn't agree more. You see, when you were talking, it was
Yeah,
thumbs up.
if I may add something, if I may add something on this, I think it's very important what Ulrik said. That I mean, there should be some kind of challenge between asset managers, you know, if not competition, or let's put it another way. I mean, there need to be creativity, and asset managers definitely should hire people specialized on that. They should spend some time. They should get educated. They should buy the right data to help them, and at the end of the day, that could help. You know, streamline a competitive edge for them. You know, simple message. I welcome the idea, but we all know simple messages come with a lot of work to synthesize this. Okay, so we say the same thing. Lot of work, education, work hard on the data and the understanding of the fundamentals, and then eventually you end up with a simple message, which is the sign that you have worked a lot. So I think we're on the same page. And of course, there needs to be a bit of standard, but I think at the regulation level, I think what the Europe has done is right, is properly done, but it's the right level of regulation, standards. We shouldn't ask for more. And now it's up to each individual asset manager, work on the fact and be the best. and there will be succeed for some, like we can see in the industry, and there will be the laggards, and obviously they will miss the biggest opportunity in the asset management industry for the years to come.
So maybe if we want to have everybody agree, then we can say that we need a minimum common denominator so that everybody reach that level. Yeah. And the front runners will have to demonstrate innovation and creativity. Yeah. In that space as well. Maybe one last question then to all of you. Maybe to Paul. Transition finance is a concept, as you explained at the beginning of that panel discussion, is a transition journey. But does it have to stop somewhere? We can't do transition for ages, right? Is there a deadline where we can't talk about transition finance anymore? We have to reach that deadline and then we stop. We stop financing stranded assets and fossil fuel and other things like that. What's your view on that?
Yeah, it's a good question. I mean, for some themes, there is a time horizon available. So we think of science-based targets, where the science has shown to avoid excessive global warming and significant climate change risks emerging, we need to maintain temperature increase to below 2 degrees, ideally to go to 1.5. But the Paris Agreement, there's time horizons embedded in that, where basically people have worked back. We have a certain carbon intensity in the economy at the moment that is implying a certain temperature increase. If we don't do anything about it, we need to limit the temperature increase here, and therefore there's a declining pathway for everybody in terms of carbon intensity. So we see dates like 2050, and net zero 2050 is quite common now in the market as a shorthand. So if you say I want to be net zero by 2050, what you're saying is I want to be in alignment with the goals of the Paris Agreement. So for some ESG issues, there is a defined timeline and a time horizon, and we see commitments being made on that basis right now. In other areas of ESG, it's much more complex, and a lot of these things are interlinked. But things like deforestation and climate smart agriculture, plastics, waste, water, all of these things are much more complex in a way. But certainly for climate, I think. The data in terms of consistency of measurement, initiatives like the Transition Pathway Initiative, I think to Ulrik's point about usable information, I think that's a great example of something which strikes a nice balance between being usable for investors, but being fair to the kind of complexity behind some of these issues in different industry sectors. and giving people a like-for-like basis to compare companies, because a lot of things in the market work on not who's best or who's worse, but where you are in relation to everybody else, and it's not so much about the absolute, rather the differential between peers, and that becomes the basis of the investment decision. So things like that, I think, are good examples, and you'll see if you look at the TPI data set, there are these decarbonization trajectories which do have a defined endpoint. So that's quite useful in that area. But outside of climate, it's more challenging to introduce the concept of time horizons.
Yes, absolutely. Thanks, Paul, on that. I see that time is almost out. So I'd like to thank you for sharing your insights and vision on that topic of transition finance today, and conclude on your wise words around transition finance. I know that your entities work hard on finding solutions, concrete solutions and instruments to finance the transition, and I very much look forward to see what's going to happen in the next few years on that side. Before we finish that panel discussion, I would like to hand over to Anja, who will be organizing the next panel discussion as part of 𝗟𝘂𝗍𝗂 after the school holidays. Anja, the floor is yours.
Yeah, thank you. I lead the Securitization and ATAD Task Force at 𝗟𝘂𝗍𝗂. We're a group of tax advisors and other securitization experts, and spent a good year discussing how the new interest limitation rules and anti-hybrid rules should be applied to securitization companies. Until 2019, tax was not really an issue for securitization companies, but as from 2019, as I'm sure all of you know, the deductibility of interest is subject to significant limitations. And that is particularly important for securitization companies that derive any type of income that is not strictly speaking interest income. So as I said, we spent a good year debating these issues, and on Monday we finally issued our technical paper, which I think is a significant milestone for the industry that I'm very proud of, also because the tax authorities have said for more than a year now that they are going to be issuing a circular, and they still haven't issued anything. So during the next webcast on 11th of November, we will discuss some of the positions that we have taken in the paper. And I think I would encourage everybody that is interested in the legal and tax aspects of structuring deals through Luxembourg securitization companies to join that webcast. Thank you.
Thank you, Anja. And again, so thank you to the audience that we don't see, but we've read your questions. Thank you to the facilitators of that panel, to 𝗟𝘂𝗍𝗂, and thank you, Laurent, Paul, and Ulrik for your very impressive insights. Thank you very much, and have a nice afternoon all.
Thank you very
Bye.
much.